Thank you very much, Camille. Good morning, everyone. Peter Osbaldstone, Research Director. The material I'm going to show you today is taken from our European Power Market Service. I'm going to look at the broad background, give you a little bit of a view of how our methodology stacks up, how power analysis and our work in power markets integrates with the rest of Wood Mackenzie's business, and then a little bit of a market study to look at a few issues around price formation. And I'm really pleased that Joe went first, because a lot of the concepts that I talk about, he's already mentioned in his presentation, from the trading point of view to the strategy point of view and the long-term outlook. So while we're all here, our view in this slide of where European power supply is going over the next 20 years or so, continued growth in wind and solar, more and more low-cost variable supply into our power systems, terminal decline in coal. By the end of this period, the only markets left burning coal in power are in Central and Eastern Europe. Most of Northwest and Southern Europe is out of coal by 2030. Germany follows a little bit later in 2038. A steady decline in nuclear as the European reactor fleet ages and new build projects are few and far between. And gas sitting in the middle there, that grey section of that chart, still maintaining quite a significant role in the market and a very important role with regards to system balancing, flexibility, and also price setting as well. So in today's market, last year we saw 1/3 of European power supply sourced from renewable sources. This year we expect more generation from gas than coal for the first time, and coal's decline doesn't look back. Coal will always be a smaller source than gas from now on out. And then within 10 years, we see a majority of European power being sourced from renewables. And as you can see, in this base case view, by 2040, a little over 60% of the market supplied from renewables as well. So we haven't got to this point today without seeing some impact from that growth in low-cost marginal supply. On the right-hand side of this chart, we've plotted market penetration of wind and solar in terms of hourly supply, proportion of hourly supply against day-ahead price for 4 of Europe's 5 largest markets. And as you see, there's a clear profile there. The more wind and solar you have in these markets, the lower the day-ahead prices. Now, we've sorted this data dependent on that percentage of penetration. So, of course, there aren't the same number of hours in Germany with renewable penetrations at 80% as there are, say, at 40 or 50%. We've just taken an average of the hours that sit at that particular level of penetration. So how do we go about modelling that, making sense of that and projecting it forward? So we use an hourly dispatch model. So chronological hourly dispatch, unit commitment, looking at the costs of individual generators, individual units in each market, how they interact with the units around them, how they interact with their market, how markets interact with one another. We tie that hourly analysis in with Wood Mackenzie's broader power and renewables and energy transition practice. So we're specialising there in wind energy, solar, energy storage and EVs. That's what we're drawing in from our energy transition business. And we're also very closely integrated with Wood Mackenzie's fuels business. So we have a great relationship with our global gas model team, for example, that supports us in forming a view on commodity costs into these markets. And given what I said about the importance of gas generation going forwards, a good understanding of global gas markets is absolutely essential. So moving now to a little market case study. This is one of the markets. This is Spain that we cover in our European Power Service. Do we have any Spanish or Iberian market specialists in the room today? Some, 1 or 2. I've got some flexibility in that case. I just had a nasty feeling there'd be a forest of hands suddenly fly up. But we start by looking at our expectations of monthly prices, market average prices out to 2040. This is all built up from that hourly level. So wherever you see a monthly average or a daily average price or supply mix, it's all supported by hourly analysis underneath that. Very distinct profile in Spanish prices moving forwards. There's this trough you can see developing, and it's there every year. And this is where the Spanish market's particularly exposed during the spring of each year to high levels of hydro production high levels of wind, and also the ramping up of solar production as we reach the warmer months of the year. There's also a clear signal here of some of the commodity trends that we've got underlying our view. So you see the period of relatively low prices in today's market, supported by low gas prices in particular. And there's a second, let's call it a trough, but a period of relative weakness in prices around the mid-2020s. And that's a second cycle of LNG supply hitting the global gas market, depressing global gas prices, exactly what we see now. And it takes a little while for the global gas market to soak that extra supply up. As a result, we see cheap gas coming back into Europe around that time. So underlying those prices, how do we actually get to that price view? This slide shows our supply stacks, our cost supply stacks. And we're looking at a number of years here, 25 through to 2040 in 5-year steps. So two distinct sort of areas of this supply stack. There's the low-cost variable supply, or largely variable supply, at the bottom there. That's where we have our wind, our solar, but also our hydro, and if the market is so equipped, our nuclear as well. So a little bit of nuclear there in Spain. So that's supply that's coming into the market at a marginal cost that, 10 euros, maybe 15 euros or below. And then there's a significant step up to the higher cost thermal generation, the coal, the gas, increasingly gas in the longer term. And that's where our commodity pricing view, fuels and carbon, starts to have a direct influence on how our prices develop. So the step up from that 10, 15 euro level is maybe up to, let's say, 55 euros in 2025. It's up to 75 euros in 2040. So, of course, from a marginal pricing point of view, if your demand on the system happens to sit on one side of that divide, one side of that threshold, or the other, you're looking at very low or very high prices. So significant potential pricing volatility emerging there, a good business opportunity perhaps for storage. And just before I leave this slide, we've based this on capability, not just capacity, but capability. So take into account resource availability for wind and solar, outage rates, etc. So a slightly better measure of what systems will actually look like than you might get if you looked at installed capacity. We can do installed capacity as well, though. So what does the supply mix look like? Again, sticking with Spain, this is 2030. This is an average day in each month over the course of 2030. Again, we've got all the hourly analysis underneath this to look at the outliers, but this is averaging a day in each month. Two measures of demand on here. Gross demand in the solid black line on the top chart, and the dashed line is the net load. So that's a link, one of the links to Joe's presentation. So when that net load gets close to zero or below zero, those are the hours where we see pressure on prices. Those are the hours when the market is balanced by storage charging, that's pump storage and battery storage, and also the utilization of interconnections with other markets. So in Spain's case, geographical location means that those interconnections might be relatively limited. We are expecting them to expand over time. Underlying that, we've got the within-day price profile averaged over those months as well. So it's those springtime months that I mentioned earlier where we see the real significant and defined pricing profiles coming into Spain. In getting from our gross to net load representation, I should have mentioned this, we take out wind, we also take out solar. You can take different measures to define your net load, dependent on what your market looks like. You can take account of your distributed generation, perhaps at that point as well. There are various options in arriving, but it all tends to balance out and give you a larger or smaller traded market in which your optimization model is going to function. So the other way we can look at this is start to break out specific technologies, look at particular sources and how they fit into this market background. I've picked out solar, but in each one of our market reports, we do solar, we do wind, we do gas and other thermal flexible generators. Coal, for example, in Germany is relevant to an extent. In France, we'll do nuclear as well to see how these different technologies fit in. The top charts on this slide are the interesting ones. The first two relate production from the source, production from solar in this case, to load. Straightforward net load in the first case. No surprise here, the more solar you have on the system, the lower your net load is going to be. We allow then in the second chart for storage. So we have a view on storage build out to 2040, and also underlying that, the capability of that storage, so the storage durations increasing over time. So the storage tends to pull in the distribution of demand a little bit, cutting out in particular those really low net load hours. And then finally we have price. And so from this chart we derive our capture price forecasts. And so we're showing generation against price here. So there's a good number of hours, quite a significant number of hours, where solar is seeing very low realised prices in the market, but it isn't always necessarily directly correlated with the volume of solar on the system. You see there at the bottom left-hand side of the chart, there are a number of hours where there's little or no solar on the system, and yet prices remain low. So that's a signal there that wind and hydro are also having quite a significant impact on price setting in Spain. Beyond that, though, there's still the majority of hours in this view at 2030. Something else is still setting the market price. Gas is still setting the market price. And so solar is then earning a significant market price in Spain, even in 2030. So our view of average market price and capture prices in Spain might be separated by maybe 4 or 5 euros at this point in time. The bottom chart is simply our production profile for that source over the course of the year. So key takeaways, some of these I've touched upon only quickly in the presentation. If you'd like to find out more, we have a stand on the exhibition floor. Drop by during the day, leave your card if I'm not around. If I'm around, I'd be more than happy to have a conversation. We see electricity as a cornerstone of the energy transition. We have seen through national policy instruments carbon intensive sources being ruled out of markets if they cannot be priced out. But so far, power's transformation has benefited from the inherent flexibility of our transmission systems, the inherent flexibility of the thermal supply base. That changes over time. There are new challenges emerging as the level of penetration of wind and solar expands. Thank you. Yes. So that is, if you cast your mind back to the supply stacks, that's the difference between the marginal price being set. So the difference you saw in the pricing distribution on that top right-hand slide, prices being set by that low-cost generation base, 0 to 10, 0 to 15 euros, and then you have to see a price increase to 40, 50 euros for the thermal plants to come online. There's nothing in between in the stack. So there's a quite clear distinction between very low, very high.
In which periods? Can you specify the periods?
That I think is shown. That is shown by the degree of variation in that bottom chart. So the system balance is under pressure, particularly in the spring in Spain. You have different markets will show different characteristics, but in our view this is how it stacks up for Spain, and it is an issue around, as you see here, through the midday hours in particular, when you've got a combined influence of hydro and wind and solar as well. Okay.
Thank you, Peter.
Okay.
Any questions for Peter?
Hello, good morning. I wonder if you see a role of solar plants that are not built towards south, but for instance towards east or west, meaning that they would have a production earlier or later in the day. Mm-hmm. And if you see that as a potential advantage, even though it might not be as attractive from a project development point of view.
Yes, I'm familiar with the concept. I think in a competitive market, you may find the space for that sort of investment. I think it would be wise to integrate that into a broader portfolio. If that was your only play, I know perhaps just going somewhere else first, but yes, there are space for many things in these markets as that renewable penetration increases. Yeah.
Any other questions? Okay, I have a few.
A few.
My first one, beyond 2030, what is your view on, will there be the right price signals to be able to bring enough renewables onto the grid, for example, to reach the Paris agreements of 2050?
Yeah, absolutely. Yes, it's not without its challenges, as I said. This background, pressure on market prices does represent a challenge to investors. There are multiple routes of entry into markets, all of which come with different risk-return profiles. There is the merchant option. And what we saw today is effectively the merchant option. If you want to go into a market without a PPA, without a feed-in tariff, that's the price you're going to take. There are alternatives. PPAs, for example, are one way of locking in a return on a project, de-risking a project, perhaps gaining access to lower cost funding. That sort of optionality, the front end of a project, I think is good, and that's a sign of a maturing market. So it's looking promising, yeah.
Okay, well, thank you, Peter. We have a